Upgrading the nation's infrastructure is something that's been in the news a lot lately, and it looks like this infrastructure bill is getting close to being approved. With a $1 trillion budget, and it couldn't have come at a better time. US infrastructure, which includes things like highways, bridges, railroads, and more, is in dire need of some revitalizing. So it's natural that investors like you and I might want to know which companies could benefit from a massive investment in US infrastructure. In this video, I've put together a top 10 list of the best infrastructure stocks that investors are looking at to try and cash in on the trend. They all have strong business models and global competitive advantages, and they all pay dividends to shareholders and will be among the biggest beneficiaries of rising infrastructure spending in the United States. But before I begin, this video is brought to you by SureDividend. SureDividend helps investors find high-quality income securities for their retirement and financial freedom portfolios. And the SureDividend newsletter analyzes their top 10 high-quality dividend growth stocks each and every month. And folks, stay tuned because I'm going to be giving you a coupon code for a nice discount. All right, folks, so let's get into it. Landmark Infrastructure Partners is the first infrastructure stock on the list. Landmark Infrastructure Partners is a master limited partnership, or an MLP, that provides real estate on a lease basis to wireless carriers for their cell towers, also to advertising operators for their outdoor displays, and power companies for their renewable energy units, and to data storage companies for their data centers. And more importantly, the company gets to grow organically without having to make any capital expenses. So how do they do it? Well, Landmark owns properties in difficult to replicate locations in major population centers and leases them to Tier 1 tenants such as AT&T and Verizon Communications. And these are tenants which can easily pay their rent, even under the worst economic conditions. Looking ahead, Landmark Infrastructure Partners has some good growth prospects. For example, the nationwide rollout of 5G is going to require adding significant amounts of equipment to the existing cell tower networks. In the advertising space, this is starting to show signs of recovery for Landmark. Advertising activity bottomed at the end of the second quarter in 2020 and has been gradually recovering since then, thankfully. As the pandemic subsides, I imagine the recovery of the advertising segment to gain even greater momentum later this year. Last year, in 2020, Landmark slashed its distribution by 46% in order to preserve cash and endure the crisis. However, things are looking up, and they're currently paying a distribution yield of 5.98%. The second infrastructure stock on the list is Enterprise Products Partners, another master limited partnership that operates as an oil and gas storage and transportation company. Enterprise Products has a tremendous asset base, which consists of nearly 50,000 miles of natural gas liquids, crude oil, and refined products pipelines. It also has storage capacity of more than 250 million barrels. These assets collect fees based on materials transported and stored. In early May, Enterprise Products reported strong first quarter results in which distributable cash flow increased 12% to $1.73 billion. I think Enterprise Products is looking good considering its long-term growth prospects moving forward, thanks to its new projects and exports. In 2021 and 2022, Enterprise Products sees growth capital expenditures of $1.6 billion and $800 million, respectively. In all, Enterprise Products has $3.4 billion of major products under construction. In terms of safety, Enterprise Product Partners is one of the strongest midstream MLPs. It has credit ratings of BBB+ from Standard & Poor's and Baa1 from Moody's, which are higher ratings than most MLPs. The company also had a leverage ratio of just 3.3x in the trailing 12 months. Another attractive aspect of Enterprise Products is that it's a recession-resistant company. Enterprise Products' high-quality assets generate strong cash flow, even in recessions. As a result, Enterprise Products has been able to raise its distribution to unit holders for 22 consecutive years. And today, units currently yield nearly 8%. And hey, guys, if you think that 8% is a solid dividend, give me a thumbs up on this video. Okay, so the third infrastructure stock on the list is Vulcan Materials Company. Vulcan Materials is another clear winner among the nation's infrastructure stocks, as it's the largest producer of construction aggregates. And what is a construction aggregate? Well, I had to check. It includes crushed stone, sand, and gravel. Vulcan is also a large producer of aggregates-based construction materials, like asphalt and ready-mixed concrete. Maintaining a strong balance sheet is important for this particular company and for their ability to invest in growth, which it does organically and through acquisitions. For example, on June 7th, Vulcan Materials announced that it will acquire U.S. Concrete Incorporated in a transaction worth nearly $1.3 billion. Vulcan Materials is also a dividend stock, albeit with a fairly low dividend yield of 0.82%. And this is below the average S&P 500 index yield, which currently stands around 1.3%. However, the company routinely increases its dividend at a high rate, including a 9% raise in February of 2021. Infrastructure stock number 4 on the list is Caterpillar. Caterpillar is an obvious choice for this list, as it's the largest heavy machinery company in the United States. Caterpillar manufactures heavy machinery used in the construction and mining industries. The company also manufactures other industrial products, such as diesel engines and gas turbines. So, as you can see, Caterpillar is one of the top infrastructure stocks. But last year, it was a difficult one for Caterpillar, as it's a highly cyclical company that needs a healthy economy to grow. However, the company continued to generate positive free cash flow, which allowed it to continue returning cash to shareholders through the pandemic. And so far in 2021, Caterpillar has seen a significant recovery as the coronavirus pandemic is ending. Caterpillar's strong growth has allowed the company to raise its dividend at a high rate over the past several years. And on June 9th, Caterpillar increased its dividend by 8%, and they've increased their dividend for over 25 consecutive years, qualifying the stock as a dividend aristocrat. And by the way, want to know more about dividend aristocrats? Check out this video here above. Analysts believe Caterpillar's dividend is safe. With a projected dividend payout ratio of 45% for 2021, Caterpillar's dividend appears secure so long as the economy keeps moving in the right direction. The next infrastructure stock on the list is Martin Marietta Materials. Martin Marietta is a leading supplier of various construction materials, including aggregates, cement, ready-mixed concrete, and asphalt. And as a result, Martin Marietta would be a big winner from a nationwide effort to improve and expand infrastructure. The company operates a network spanning 26 states, along with Canada and the Bahamas. In early May of 2021, the company announced strong first quarter financial results. Total revenue increased 2.5% to $982 million. Both the company's major segments, building materials and magnesium specialties, posted year-over-year revenue growth. Adjusted EBITDA increased 37% year-over-year due to revenue growth and margin expansion. And earnings per share more than doubled in the first quarter. Organic growth through an expanding economy and acquisitions will provide future growth for Marietta Materials. The company pays a dividend to shareholders, but the yield is fairly low at just 0.63%, although the company does increase its dividend on occasion, such as a 4% increase in 2020. Still, the stock is not likely to generate any meaningful returns from dividends. Instead, capital gains through high earnings growth will provide the bulk of shareholder returns moving forward. Infrastructure stock number 6 on the list is Nucor Corporation, the largest steel producer in North America, which would make it a clear winner from a major new round of infrastructure spending. Nucor manufactures a wide variety of material types, including sheet steel, steel bars, structural formations, steel plates, downstream products, and raw materials. The majority of the company's production comes from a combination of sheet and steel and bar steel, and has been the case for many years. Despite operating in the notoriously volatile raw materials sector, Nucor is a remarkably consistent dividend growth stock. The company has increased its annual dividend for 48 consecutive years, which qualifies it to be a member of the Dividend Aristocrats list. Nucor has the longest streak of annual dividend increases among the top infrastructure stocks. Infrastructure stock number 7 on the list is Kinder Morgan, one of the largest energy companies in North America. They're an energy infrastructure stock as it's the largest natural gas importer, moving approximately 40% of the natural gas used in the United States. It's also the largest independent transporter of petroleum products and carbon dioxide, and the largest independent terminals operator. It's engaged in the storage and transportation of oil, gas, and other products. Kinder Morgan owns an interest in or operates approximately 83,000 miles of pipelines and 144 terminals. And their transportation assets operate kind of like a toll road, so the company receives a fee for its services, regardless of the price of the commodity. And approximately 90% of Kinder Morgan's cash flow is fee-based. Kinder Morgan is currently paying shareholders a dividend of 6.21%. Another good dividend. Number 8 on the list of infrastructure stocks to look at is MPLX. MPLX is a master limited partnership that was formed by the Marathon Petroleum Corporation in 2012. The business operates in 2 segments: logistics and storage, which relates to crude oil and refined petroleum products, and gathering and processing, which relates to natural gas and natural gas liquids. The company's logistics and storage segments has pipeline capacity of 4.7 million barrels per day. On May 4th, 2021, MPLX released their first quarter results for the period ending March 31st, 2021. For the quarter, net income equaled $739 million compared to a loss of $2.72 billion in the first quarter of 2020. And distributable cash flow equaled $1.137 billion, or about $1.10 per unit, versus $1.078 billion, or about $1.02 per unit last year. MPLX ended the quarter with a consolidated debt to adjusted EBITDA ratio of 3.9x, down from 4.1x in the first quarter of 2020. And their distribution coverage was 1.56x, compared to 1.44x in the year ago period. And MPLX has some positive growth prospects, primarily due to its projects currently under development. MPLX is an attractive MLP for income with a forward dividend yield above 9%. Still, even if there were significant cuts, MPLX would still have a very high yield, and barring another fierce downturn, the distribution appears safe, particularly if the economy continues its recovery in 2021. Infrastructure stock number 9 on the list is Brookfield Infrastructure Partners, one of the largest owners and operators of infrastructure networks, which includes operations in sectors such as energy, water, freight, passengers, and data. Brookfield Infrastructure Partners is one of 4 publicly traded listed partnerships that's operated by Brookfield Asset Management. Brookfield Infrastructure Partners is a large cap stock with a market capitalization above $20 billion. The company performed relatively well in 2020 given the economic downturn. Along with quarterly results, Brookfield Infrastructure Partners also raised their distribution by 5%, the 12th consecutive annual increase. Strong performance continued in the first quarter of 2021, and the company has expanded its diversified portfolio of quality infrastructure assets in recent years. More recently, in February of 2021, Brookfield Infrastructure Partners offered to buy Inter Pipeline for $10.6 billion. However, Inter Pipeline refused the offer on the grounds that they believe they're worth far more money. All right, folks, before I get to number 10 on the list, remember that promo code I mentioned earlier for the Sure Dividend newsletter? Well, guys, because you're watching this video, you can use my coupon code FIM41OFF to lock in savings of $41 a year and get instant access to the newsletter with a 7-day free trial. I also went ahead and left you a link in the description below. Okay, so the last but not least infrastructure stock on the list is Union Pacific, the largest railroad company in the country, and operates more than 32,000 miles of rail throughout the western 2/3 portion of the country. Union Pacific transports industrial and agricultural products, as well as coal and chemicals. The company generates $21 billion in annual revenues. Earnings per share have increased at a rate of almost 9% per year over the past decade, and over 10% over the past 5 years. Analysts expect a 7% annual earning per share growth over the next 5 years. Railroads are natural beneficiaries of infrastructure spending, and Union Pacific is optimally positioned as the largest railroad. Union Pacific has increased its dividend for 13 consecutive years, making it a blue chip stock. And by the way, if you want to see more blue chip stocks, feel free to check out this video. Folks, this has been fun. The 10 infrastructure stocks on this list come from a wide variety of industries, such as oil and gas, steel, energy infrastructure, investment in infrastructure assets, and more. But what they all have in common is that they stand to benefit from a massive infrastructure spending plan. U.S. infrastructure is in dire need of a major facelift, and it looks like it's going to get done. Do you own any of the stocks on this list? Go ahead and let me know in the comments below. In the meantime, thanks so much for watching, and I will catch you in a future video. Bye, guys.